Now to discuss other news that's around and hopefully a few scandals is Adam Schwab, our regular business commentator and author of the wonderfully named book about executive excess, Pigs at the Trough. He joins me from Melbourne. Hello, Adam.
Hi Janine, how you going?
Good, thanks. Look, we'll start with something. I was on the Paul Murray show last night on Sky News and there was a lot of talk about a report that came out yesterday claiming property prices were going to rise 20%. I thought, you know, it was another of these stupid reports, ramping. If it was a share, we'd be outraged. I notice you've been writing a lot about the property bubble and the reporting of it lately.
That's true. The report yesterday was an interesting one. You see a great number of PR releases coming out, and yesterday's was a classical example. It was released by QBE, one of QBE's subsidiaries that actually provides mortgage insurance. I think it's QBE LMI it was called, and they, together with a company called BIS Shrapnel, produced a report saying that property prices would rise 20% in the next few years. Pretty much every report that BIS Shrapnel ever produces seems to say that property prices will rise by about how much they've been rising in the last few years. I'm not sure if it's a coincidence or there's some real thought going into that. But the other body that seems to always be saying prices are going to keep rising, or there's a shortage, is the HIA, the builders' union, so to speak.
Well, they would say that, wouldn't they, Adam? They're the Housing Industry Association.
They certainly wouldn't. I guess what makes it tough for the average mum and dad out there deciding whether to buy a house or sell a house, or more importantly, perhaps buy an investment property is what is the real intrinsic value of property. And it's very hard to look through the haze and the murk and the self-interest that you see from people like the HIA and the Real Estate Institute of Australia or Victoria or New South Wales, and look to what the real situation is. And there isn't all that much genuine information out there. What we do know is that property prices since about 97, 98 have risen by around 150% at a median level. And rents have gone up about 108%. So prices have outstripped income by around, 40 odd percent. So generally when you see price growth outstripping earnings or income growth, it's a real sign that there is a bubble in existence. And even...
Go on.
Even Dr. Lucy Ellis, who's the RBA stability head, who just a few months ago was denying the existence of a bubble and disclaiming it, just last week noted when you see yields getting absolutely decimated, it is a sign that, well, there perhaps could be a bubble. She didn't say the exact words, but reading between the lines, that seems to be what she was hinting at.
Well, we had even the IMF said that property here is overvalued. Now, while I concede the report yesterday mentioned that we're in the midst of a commodity boom, the economy looks good, I mean, this 20% figure, you could have plucked it out of the air, couldn't you?
It seems like it very much was plucked out of the air. There's a couple of metrics that are regularly quoted when trying to determine whether property is fairly valued or overvalued, and a common one is the house price to disposable or household disposable income ratio. And traditionally Australia and the US and most developed countries average about 3. So 3 times household disposable income is what generally the median house price should be. And in Australia, in capital cities, it's leapt to about, depending on how you calculate it, between 6 and 7, which is around double the traditional average and more than double what it is in the US, which we all know has seen houses drop about 30 to 40% since 08. And so on that basis, it looks about 40 to 50% overpriced. If you look at the yield you're getting on property, which is obviously not everybody buys a property for an investment yield, but arguably, even if you're living in a property, it can still be compared to an investment. You're looking at an average net yield on the median price of around 2%. And just to compare, you put your money in not even a term deposit, just a bank account, a net saver account, and you're getting about 6% interest. So comparing property to even a relatively risk-free investment, is you're getting a fraction of the yield for what should be a higher returning asset.
You've also made the point that if property prices are doing so well, are going to, why haven't rents gone at the same pace?
Yeah, it's a great point, Jane. That harks back to the shortage argument, and one of the key arguments proposed by housing bulls is that house prices will keep going up, and you won't see a bubble burst because there's just this huge shortage of properties. And there has been instances in the past few years where there has been pockets of shortages in certain areas. But as you said, if rental prices have barely moved, and if you look in the last quarter, in pretty much every capital city, the Financial Review reported that RP data found that rental prices didn't actually increase at all in the last 3 months. So you've got this supposed housing shortage, yet rental prices aren't increasing, which is laying real doubt onto the fact that is there a real shortage? And if there was, surely if you've got the choice between living on the street and paying more rent, most people pay more rent. So the facts seem to dispute this sort of housing shortage myth, and that's really what's been holding up house prices, that and a very long period of low interest rates.
And isn't it a case that the media is breathlessly reporting this? When I started financial journalism, you were allowed to do this on shares. It was called ramping, and people used to do it to say, you know, this will go up 50%. There's controls in now. Obviously, property's more general, but it has the same feel of it, doesn't it? I mean, Saturday evening news programs start off with what the market's done, and real estate agents have no more ethic. I mean, they make stockbrokers look really good, don't they?
Very much so. It's real estate's the one. House prices are one of the few things where people seem to actually want inflation. If you're looking at the price of apples or a beer down at the pub or cigarettes, nobody wants inflation. Nobody wants prices going up. But when people see the value of their house going up, they suddenly are celebrating, when in reality, you ultimately, if you're going to sell your house, you're going to be buying again in the same market. So, if anything, you're paying higher transaction costs, paying higher stamp duty, paying higher agents' fees. So, the only people who really benefit from housing prices increasing are state governments who reap more stamp duty, real estate agents, obviously, who are paid based on the value of the house they're selling, and perhaps property investors who are liquidating their portfolios. But in real terms, most people actually suffer from house prices going up, and certainly if you don't own a property, and if you're trying to buy a property, and if you're a young family looking to buy your first house, they're certainly suffering greatly from the property price increase, and it also leads to if it is a bubble, and if that's borne out as what's occurred in the US and very much in Ireland, you see a massive misallocation of capital. So instead of investors putting money in real income generating assets, they're putting their money in a property which serves minimal utility other than perhaps shelter. I
noticed one thing that I did seem to agree with was that Melbourne was left out of the big boom they were predicting. You were only going to get a 9% increase, I think, as opposed to Sydney's 20%. I think it's saying that maybe you have overinflated. I mean, Melbourne's been ridiculous, hasn't it?
Melbourne very much has sort of led the pack. Sydney, obviously, in the early part of this decade, followed by Perth as the mining boom heated up. And the last sort of 2 or 3 years, Melbourne has rocketed about 15% last year. And you see reports of some properties, a property in fashionable Richmond, which sold for, I think it was $400,000 in 2008 and sold for $650 2 years later this year. So you see these extraordinary increases in prices in the same time that rental, so the income attaching to that asset has sort of eked up by maybe 10 or 15%, and inflation's up by about 10%, and income's up by about 10-15%. So you've seen asset prices vastly outstrip every other metric, except for perhaps leverage, which is conveniently increased as well at a similar rate.